What's going on, guys? Welcome back to the channel. In this video here, we're going to be doing a stock analysis on Intel. My name is Leo and my channel is dedicated towards all things investing. So without further ado, let's jump into the company. We're going to load it up in our stock research tool and we're going to determine a fair price to pay for this business by going through the fundamentals, the financials. So without further ado, here is the stock research tool, jumping into the first category, and that is our company metrics. Now, if you're new here, what I like to do is take a look at the 5-year numbers, compare them to the trailing 12 months, and try to gauge where this company is going and if they're making improvements. So with Intel, right off the bat, and full disclosure, I am a shareholder of Intel. I'm slowly growing my position, and I like this price right now. I'm just going to give you guys the heads up, but I'll tell you why I like it. We have a low PE ratio, and it's being dropped down to the trailing 12 months at 9.63. EPS is higher than our 5-year average. Good return on equity, and a profit margin is consistent. So right off the top, these consistent numbers with high return on equity and PE and EPS makes Intel so far very attractive. Our revenue is $79 billion compared to our net income of $19 billion, and our free cash flow is sitting at $9.66 billion. A little bit of a drop over our $14.4 billion average. Now, here's the thing, folks. Pat Gelsinger, the CEO, announced, and he gave out his plan in terms of how he's going to start, competing against the likes of Taiwan Semiconductor, AMD. There's going to be a slight decrease in free cash flow, and he made that incredibly clear. So that is definitely reflective of this. They're building a lot of plants and foundries. I believe they're building one in Ohio. They're building one, and it's off the tip of my tongue. I can't remember where, but they're building a lot of foundries to try to increase their chip production because of this whole chip shortage. So they're making strides and putting their free cash flow to work to get those programs off the ground. So that's phenomenal. However, there is a slight dip in their free cash flow, but obviously it is justified because this is what's happening, and eventually it's going to be reinvested. Now, the one thing that has me a little bit concerned, though, is we do pay out a 3% dividend, which is great, and we are able to cover it. Because while it is $5.6 billion that is being paid out, we have the $9.66 billion that we're currently at can easily cover that, as well as our 5-year free cash flow average is at $14.4 billion, so it's easily covered. However, my concern is now with the free cash flow going to be dropping over the next potentially 5 years. This is a huge chunk of your free cash flow, sitting at around $9 billion. $4 billion of it is going to be left over just after the dividend, so it's a little bit steep. If I would rather them, to be honest, decrease the dividend yield, or just get rid of the dividend completely and just go to the wall and just floor it in terms of like maxing out chip production, because that'll just pay dividends on its own once the revenue and everything just starts moving and grooving. However, we'll cross that bridge once we get there, and I have full support, or I fully support Pat Gelsinger. So we'll see the decisions that he makes. Return on invested capital is sitting at 13.80 compared to 17. A slight drop off, but high nonetheless. Alma Z-score 3.27. We want that over 3, folks. We have that. PA Trotsky score is sitting at 7, and that's pretty good. We want that number to be between 7 and 9, and we have that. And 9 is essentially the highest score we could possibly achieve. And Almond Z score, as we said, is at 3.27. That means they are safe from being bankrupt, but you probably knew that. These free cash flow numbers and revenue are just phenomenal. So, I mean, I like Intel. So I'm a fan of this company. So those are the company metrics. And those are the reasons why. They have solid revenue, solid free cash flow, and net income is also high. Let's jump into our financial evaluations, where we're going to score this business. And looking at that here, we are scoring this at 9 out of 10. 9 out of 10, folks. They are green pretty much across the entire board except for one key category, and that is our free cash flow growth. But as I explained earlier, the reason why is because of the investment that they're doing. And yeah, I'm fine if they're investing into themselves. Listen, I totally get it. I totally understand. I'll take the hit. But let's see what Intel is doing right, and that is a lot. They have a low PE ratio. We want that underneath 22.5. It's at 14.05. Current ratio 2.10. At 2 point, like, we want this number to be over 1.5, folks. It's double. It's not double. Sorry, what am I saying? We want this number to be over 1.5. So our PE ratio is at 4.1405, which is great. We want this to be underneath 22. Our PE ratio is 14.05. We want this number to be underneath 22.5, and we have that. Current ratio is sitting at 2.10. Over 1.5 is where we want to be. We have that, no problem. That means they're able to cover their liabilities because they have a lot of assets on hand. Technically, double. They have double the amount. Return on equity average, 23.18. We want that over 15%. They're at 23%. Folks, these are phenomenal numbers. EPS growth, huge increase over the last 5 years. Debt to equity, also sitting at a low multiple at 35%. Listen, guys, we want this underneath 50% because that would mean that they're building the business through equity and not through debt. And we have that at 35%. Share dilution, probably one of my favorite categories, and what they're doing is that they are buying back shares. A negative 3.29% buyback on their shares means that you are owning more of the business, and if they continue doing that at these low prices, that is not a bad way to spend the free cash flow. By building their foundries, buying back shares, paying out a dividend, they are making the right decisions. Now, I still stand by what I said earlier about the dividend. If they cut it, I wouldn't be too distraught about it if they're going to just use it to buy back shares, because, you know, listen, that just gives me more access to that free cash flow anyways. Now, net income growing. Return on invested capital over 10%, 17%. Now, our 5-year revenue growth, it's at 5.97%, folks. It's slow growth, but it's still growing nonetheless. It's a $200 billion industry. It's a behemoth in terms of semiconductors. Now, I would say this is looking pretty good. And our only gripe here is the free cash flow, but we know where that's going. They're buying back shares. They're doing all the right things, folks. This is a company that is, I think, definitely in a value range. So let's jump into a price analysis. But before we jump into a price analysis, folks, if you're enjoying the video so far, make sure you smash that like button and hit the subscribe button. It's all found down here below. And if you're interested in the software that you see on my screen here, this will be an app. Send me an email. My email will be also found in the description box down below at invicticamedia@gmail.com. So stay tuned for that. This is something that you can use to analyze any company you would like to look at, screen it, put your own assumptions in, which you'll find out in just a quick little moment. So stay tuned. Now, I want to do this one. You don't want to see my big face. You want to see my small face in the corner here. This is what you want. So here's a price analysis. We're going to look at a 10-year evaluation of Intel. We're going to populate these boxes and determine what is a fair value. So stay tuned for just a quick second while I populate this. So if you're new here, I like to stay as conservative as possible. So with my revenue growth numbers, I've gone 3, 4, and 5% because, listen, they hit that in the 5-year and the 10-year numbers. I believe they could still do that. Profit margin, I'm going to keep that pretty much around the same with a slight discount because I believe they're able to hit their profit margins. And Intel is a company that I know they are sticklers for sticking to those profit margins, so they should be able to do that. Free cash flow margin, I'm going to apply a little bit more of a heavier discount just because well, they're probably be bringing in less free cash flow. And price of free cash flows, keeping it at a low multiple of 12, 14, and 16. PE ratio at 10, 12, and 12.5. Now, does the 12.5 make sense? I am saying yes just based off the 5-year PE ratio, but essentially as the company gets larger, you should be paying a lower multiple for a business. So this 10-year number is what I'm really looking for. This is the unicorn list, folks. Let's put a desired return in at 13% to give us that margin of safety. Check it out, guys. Check it out, these numbers. Current price is at 47.02. 48.33 is our average calculation. This is why I like Intel. This current price right here, assuming what we got here. Now, conservative category is a little bit in the red. However, if you're able to get this around 40 with this margin of safety going on, it's pretty much almost a buy all day if you believe this number and these numbers. To get that, that's for a 13% return. Now I could decrease the desired return. Obviously, it'll jump it up a lot more, but we want to put a higher return because ultimately you could essentially put your money into, let's say, an ETF or whatever. Obviously, something like VOO, or for my Canadian friends, VFV or IVV, or SPY for the Americans, and that'll roughly give you around a 10% return annual per year. We want to put something a little bit more heavier, just because if we're able to do that, that gives us a little bit more of a discount and a higher discount rate, margin of safety, as well as if you're going to invest in an individual stock, you should essentially put something higher, like make it worth your while. You know what I mean? So that's what we're doing with the 13% return here, folks. So if I am able to if this price is able to go just beneath 45 again, and I think that'll happen once they report earnings. I don't know when that's actually happening. I definitely should include that into this program here. But once they report earnings, the going joke with Intel is that the stock price always drops down, even though they pretty much crush it, if not come super close. So those are my thoughts on Intel, guys. It's definitely trading in that value category. And with the chip shortage and with the foundries that they're being built and the free cash flow numbers and the revenue that's growing, there's a lot of runway with this business. The chip shortage is not going to slow down, and they are one of the top players in the market. The only person that can really compete with them is Taiwan Semiconductors, and although a lot of people are going to say, oh, but AMD and AMD this. Listen, AMD is a phenomenal company, but in terms of what they actually bring in, like I'm pretty sure they bring in like $15 billion of revenue. Yeah, I'm pretty sure they brought in like $15 billion of revenue. Intel's a company that literally has that on cash. They literally bring in, they just sitting in their bank account, they got a wad of cash that's equivalent to what AMD brings in as revenue. That's not even including what they have as free cash flow and whatever. You know what I mean? So you're kind of comparing, you got this David and Goliath type thing. So I'm not saying not to knock AMD by any means, but this is it's a slow moving behemoth, but when it starts making strides, it's going to make some big strides. So those are my thoughts on this company. I believe that once they get these foundries done, and I think they're going to bring a lot of business back to the US, because a lot of now these chip companies are now dealing with Taiwan. But if they're able to manufacture here, I don't live in the US, but if they're able to manufacture in the US, then I think it's just going to be just more of an incentive to get other companies on board. And I believe, I could be completely wrong, I thought they were going to be doing some sort of partnership with NVIDIA. I could be completely wrong. I thought I heard through some grapevine that they were gonna do something with them. I'll touch base with you on that. But what are your thoughts on Intel? Do you think it's a value play? Write it down in the comments below. Let me know what other companies you want to see evaluated. And guys, I'll see you in the next one. $48 on average price for Intel to knock out a 13% return. Listen, I like it, but that's what I like. Do your own due diligence. Remember, this is not financial advice. This is for entertainment purposes only. Use your mind. You're smart. Now, I'll stop talking. I'll see you in the next one. Thank you so much.